Please stop looking at the PE ratio. It's a mendacious lie. If you're trading based on valuations, you might as well be navigating the Atlantic Ocean with a map of Narnia. Here is the nightmare scenario you face, I face, we face every single month. The economy is slowing, factories are closing, the consumer is tapped out, they're broke, right? But we, me, you, being the logical, rational geniuses we are, we buy puts. You can short the market, we know that. And then what? The market rips 3%, of course it does, right in your face. You get a margin call while the news anchor talks about a recession on the line, coming around to a corner near you. You feel like you're talking crazy pills. You aren't crazy, you're just late. We've all been there. You are losing money because you are trading first order effects. The news itself, right? The first derivative. The smart money is trading the reaction function. They aren't pricing in the disaster, they are front running the ambulance. They are perceiving how the reaction to the hemorrhaging patient is going to be 2 steps down the line. By the end of this video, with Justin Banter at the House of Trade, I'm going to lobotomize you. No, I'm going to lobotomize the part of your brain that cares about economic fundamentals, okay? I'm going to show you how to trade the only thing that matters, the Federal Reserve's panic threshold, their propensity to print money and to ease economic conditions. You will hopefully stop being the liquidity and start being the apex predator. We are going to have to dissect the economy. We're going to have to dissect the Feds. We're going to have to look into what they call the Fed put. We will travel back to the 90s, 1987 specifically, to see where this addiction started. We'll break down the option Greeks, specifically why Delta and Theta are destroying your bearish thesis, and we'll map the planning of the global capital flow plumbing. This is the red pill, so you better swallow it, okay? Now, let's introduce our protagonist for today. We like to do a story here at the House of Trade, and today's no different. Let's call him Pablo's Market, like, Pavlovian. You know the experiment. You ring a bell, you feed a dog, eventually the dog salivates just at the sound of the bell. The Pavlovian loop, right? Wall Street is that dog. But the food isn't steak, the food isn't beef, the food isn't poultry, the food is liquidity. And the bell is that bad news that we're talking about and the reaction function that comes from it. So for the last 40 years, every time the market has thrown a tantrum, the Federal Reserve has stepped in with a treat, a dog treat. In this form, it's not biscuits or kibbles, it's rate cuts, QE, twists, operations, TARP, TINA, whatever, all of those acronyms, right? The market has learned that a broken leg means morphine. It means morphine is coming. The drip is fully loaded. So now, when it breaks a leg, it doesn't cry, it gets high. This is why your shorts aren't working immediately, right? You see the broken leg, and correctly, you anticipate that this is bad news. But what does the market see? The market sees a fresh prescription of that monetary methadone, that sweet QE. Let's go back to the scene of the crime. October 19th, 1987, Black Monday. The Dow Jones falls 22% in a single day. Can you imagine? If that happened today, you'd see influencers live streaming their own tears on TikTok and like hyperplaning or aquaplaning on a stream of tears. It'd be crazy. You couldn't even imagine that. Before this moment happened, the Federal Reserve's job was boring. It was about stable prices, but Alan Greenspan changed the entire game, right? The maestro, I believe they used to call him. I wasn't around back then, I'm too young, even though my knowledge belies me, whatever. Anyway, he saw the crash and immediately flooded the system with what? Liquidity, stake. He essentially told the market, if you fall, I will catch you. And this was the birth of not just the Greenspan put, but the Federal Reserve put. That moral hazard that's convinced us to BTFD, buy the something dip. This is a family channel, boys and girls. I won't be dragged into that barbarity. Think of a put option. It's insurance, right? It pays you in the event that the market crashes. Greenspan effectively gave every single trader on Wall Street a free put option, underwritten by your US dollars, right? But why does this matter? I know I'm talking in histories. This isn't a historical lesson, even though past is indeed prologue. Why does it matter today? Why does it matter right now? Well, because there's nothing new under the sun, and there's especially nothing new on Wall Street. The game has not changed, only the players, right? The market realized in 1987 that the risk was no longer real. If you leveraged up and won, you get to keep the profit. If you leveraged up and crashed the system, the Fed bailed you out, right? It's the ultimate heads I win, tails the taxpayer loses and loses their house. And you're wondering why valuations are so high now? Valuations are high because the downside risk has literally been nationalized. The profits have been privatized and the risk has been distributed and nationalized in your pension, in your kids' futures. So let's fast forward to 2001. The dot-com bubble bursts. Companies with zero revenue and logos drawn in like Microsoft Paint, they're vanishing at a clip. The economy obviously is entering a recession. And what happened then? We got a rally. Why? Because the market sniffed out the rate cuts before they happened. The clever money didn't wait for the economy to recover. They bought the anticipation of cheap money. It was never my thinking that made the big money for me, right? If I'm actually thinking about it. It was me sitting on long positions while the world burned, waiting for the Federal Reserve, the Bank of England, the BOJ, the ECB to come in and save us. And they always came in and saved us. Then look at 2020. Let's fast forward it. If this isn't enough evidence backing up my exculpatory means to seduce you into the belief that I'm right. 2020. This was the true masterclass. The global economy literally stopped. It was illegal to leave your house. Do you remember those days? They weren't halcyon at all. GDP obviously collapsed faster than a shaky crypto project, right? And the S&P 500, obviously it collapsed and it's trading at zero. No, don't be ridiculous. It made new all-time highs within weeks, at a push months. If you traded the economy in 2020, you went broke. If you did everything right, if you thought macroeconomics 101, geopolitics, liquidity flows, capital flows, how the economy responds to declines in productivity, declines in work, you would have done everything right in terms of thinking, but you would have gone broke. You would have got everything wrong in terms of how asset prices actually moved. Because you looked at the unemployment lines and you shorted, right? Makes sense. If you traded the plumbing, you saw the Fed expanding its balance sheet by up to 3 trillion in weeks. You bought the calls, you knew what was happening. This is why liquidity always trumps fundamentals. Liquidity always trumps technicals. Liquidity is the truth staring at you with a 1,000-yard stare. The lesson is simple. Don't fight the Fed, we know that. But more importantly, don't fight the anticipation of the Fed. That's the second order thinking. That's the deeper derivative. The market is a discounting mechanism. We all know that. It doesn't care about today's GDP. It cares about the liquidity conditions 6 months from now. How John and Joan feel in 6 months. How much money they have coming through their paychecks. How much discretionary spending they're willing to do in 6 months. Not now, it doesn't matter. If the Fed is panicking, you should be buying. I know the short-term pain doesn't feel great, but you should be buying for a longer-term view. Sizing correctly, using leverage sensibly, and sizing properly, right? It's like seeing a bartender announce free drinks for the next hour. You don't ask if the bar is comfortable and profitable. You just order a double straight away, right? So let's get a bit more technical. I told you I wouldn't bore you with the gamma today. I've been talking about gamma like my name's the Hulk and I'm in charge of a gamma ray or something. Let's talk about the other silent killers in the Greeks. Delta and theta. You thought you were going to get away with the Greeks today, but you're not, because this is the House of Trade with Justice Banter. Like, share and subscribe. When you short the market during a big bad news rally, you usually are buying puts, right? You are betting directionally, one way. You are looking for the negative delta. Here is the problem. When the Fed pivot narrative takes hold, the VIX, which is the volatility gauge of how cheap or expensive options are in times of like fear, that usually gets crushed. VIX gets crushed. Why? Because the fear of a crash evaporates if Daddy Powell, Daddy Bernanke, Daddy Greenspan is there standing guard, promising to pat you on the head and put a band-aid over your leaking portfolio, right? Because when volatility drops, the value of your puts drops. But it gets worse. Let's talk about theta, which is time decay. In a Fed hopes rally, the market often grinds higher. It doesn't rocket, it floats. It's a slow, painful drift upward. This is a torture chamber for bearish positions, right? Every day, the market doesn't crash. Your put loses value due to that theta. It's the time decay, right? You are bleeding chips just to stay at the table, just to have the skin in the game. Meanwhile, the bulls are long the delta. They are just riding the exposure. And the market makers, our favorite people ever, the guys selling you those puts and selling you those calls, they are short the options you bought. As the market drifts up and volatility dies, they can reclaim all of their hedges. They stop selling future vol, they might even buy them back. You are fighting a mechanical liquidity drift. The market is climbing a wall of worry, but it's taking the escalator. You're trying to run down and up the escalator, and you're wondering why you're out of breath and why your portfolio is bleeding, right? Men who can be right and sit are uncommon. That's a famous phrase from Jesse Livermore. Most of you are right about the economy, you're right about the play, but you can't sit still because theta is eating your account live just for the privilege of being in the positions, right? So this brings me to the core concept of this video, the reaction function. I probably should have addressed that like 10 minutes ago. Maybe I did. The reaction function. The market is not an observer of the economy. It's a predictor of future policy. And here is the formula. Bad economic data plus a hawkish Fed equals a market crash. But bad economic data and a dovish Fed equals a mission to the moon 2.0. You need to understand the Fed put psychology. It creates a perverse incentive structure where bad news is celebrated and used, right? When the job reports miss, the algo doesn't read, people lost jobs, oh no, Joan and John can't afford cheese. The algo reads, probability of a 50 basis point cut just increased to 80%. And that's how you'll hear all of the mainstream media talking about it, and the option markets, implied pricing in further rate cuts. It instantly buys the futures. It's the algo I'm talking about. This is forward pricing. The market is pricing in the liquidity that will be injected to fix the problem you are seeing today. And that's why it makes no sense that the price doesn't collapse immediately, because they're not pricing in immediate Armageddon, they're pricing in future halcyonic paradisical bliss. That's what's going on. It's like cheering for your car to break down because you know your rich dad will buy you a Porsche to replace it if it does break down. It's like cheering your house burning on fire because you know the insurance payout is greater in value than the furniture in your house, right? You're trading the upgrade of the event, and it's perverse, but that's what makes us money. If you are waiting for the official pivot, you're way too late. The move happens when the probability distributions of the pivots shift in your favor or against you, right? And that's when the pricing is least discovered and least efficient. By the time Powell actually cuts the rates, the S&P 500 has already rallied 15%, and then the point of entry just gets way harder. The big money, that money that I hate the term smart, I hate that term, but the big money is not in the individual fluctuations, but in the main movements. And the main movement is always dictated by the cost of capital. So, talking about the cost of capital, let's zoom out into the global plumbing, which is capital flows. Money is liquid. It has to go somewhere. It hates cash because inflation eats it. It hates bonds when they yield low amounts. Labor goes to where it's treated, where it's cheapest, and capital goes to where it's treated best, is the famous maxim. When the global economy gets scary, where does that money go? Does it go to Europe? No, their energy sector and their regulation is a disaster, right? They say innovation happens in America, imitation goes on in China, and regulation happens in Europe. That's for a reason. Does it go to China, this money though? No, regulatory risk is too high. Does it go to emerging markets? No, too volatile. It flows to the United States specifically. Specifically, United States large cap tech, Apple, Microsoft, Nvidia. These are the cleanest dirty shirts in the liquidity basket. And what we're talking about on this channel is pure liquidity, because that's what determines everything. Liquidity flows. Even if the US economy is slowing, it's slowing less than everyone else. When you look at the GDP prints of America and you compare it to like behemoths like China, you actually think, hey, the GDP prints in America are actually quite strong and robust, which is why all this recession talk is nonsensical in my opinion. But I digress. So what happens even if the United States economy is growing, but not growing as much as China, but growing faster than everyone else? Well, the dollar strengthens, which usually means Capital just parks itself in the Nasdaq. So that creates the illusion of a bull market, but it's not really a bull market. It's a capital flight. It's a panic made of GPUs and iPhones. Because if you look at the chart and you see greed, if you look at the chart and you see fear, if you look at the charts and you see any one of these things, you have to remember that they are buying US tech because they are terrified of everything else comparatively. And here's the kicker. The S&P 500 is market cap weighted. If everyone hides in the top 7 companies, the index is obviously going to go up. The other 493 stocks could be bankrupt and the index will still be green. So you are shorting the index because the economy is bad. But the index isn't the economy. The index is a liquidity sponge for global capital that has nowhere else to hide. So does this madness go on forever? Can we just print our way into utopia? No. Obviously, there is a limit to all of this. The game works as long as the issue is liquidity. The game stops when the issue becomes solvency. And that's when we saw huge global financial crisis, when solvency actually became an issue, right? And when Lehman Brothers actually threatened to make the entire system insolvent. Liquidity is different to insolvency. Liquidity is, I don't have the money right now, mate. The Fed can fix that, right? They can print cash, but solvency is, I owe more than I own, and I'm bankrupt. The Fed can't fix that without breaking the currency. So I'm gonna leave you with that. I don't wanna make this video too long. But if you take away one thing, the signal you need to watch is not the stock market. It is liquidity. Watch the spreads. Watch the credit default swaps, also known as the CDS. Watch how much money is flowing into certain markets. Watch the commitment of traders reports. Watch how bad news never has the reaction you think it will. Start thinking about the market as a discount pricing mechanism. And everything has to be viewed in how the liquidity spigot is going to react down the line. Not the Armageddon now, but a paradisical moment in the near future. My name's Justin Banton. If you've liked this video, hit that subscribe button, hit that like button, hit that share button. Ciao for now. See you next time.